has been TCS. It has been trading weak after missing the street's revenue estimates for the fourth straight quarter. Of course, the margins were better than what the street was estimating for sure. But what was the key highlight this quarter? And more importantly, has TCS been able to further its digital dream? Menaka Doshi was in conversation with the management. She has all the details. Menaka.
It's another miss in revenues for TCS. But the highlight of this earnings report is TCS's digital business. The company has given some data on the digital business for the first time. For instance, the digital business contributes 12.5% of TCS's current revenue, which on an annualized basis would amount to about $2 billion. More interestingly, it's growing in double digits, more than 10% on a constant currency basis. TCS CEO N. Chandrasekaran told me that given this momentum in the digital business, he expects that it will outperform TCS's earlier target of about $5 billion in digital revenues in the next 2 to 5 years.
You're likely to outperform that.
You're likely to outperform that? Okay, so obviously the next logical question then is by how much?
We don't know. I think the momentum has been good, Menaka. I think it's picking up very fast. But the thing is that the digital business will permeate through all the other service lines. Okay, and how fast it will happen in each of those? It's happening very fast in something like big data analytics, pretty strong. Multi-channel is pretty strong.
Okay.
And the cloud transformation is beginning to happen. So we just need to see. I would like to see the trend for 3-4 quarters before I can really calibrate it.
Now that you've built some momentum in this business, I'm going to ask you a question.
That's why I shared the numbers. Otherwise, I wouldn't have.
No, I understand that. I'm going to ask you a question that I've asked you before, but at that time the business was far smaller for you to give us more color. The size of the deals you're striking in digital, are they growing? Are they coming anywhere close to your traditional business and the size of deals there? What are the margins looking like? Can you give us some more detail on your digital business?
I think there are 2 or 3 trends I can give you. Overall, the sizes are increasing sequentially.
Okay.
But if you ask me whether we will do a $100 million deal in digital, the answer is no.
Okay.
Okay.
So there are
$100 million budget will be there.
Right.
But it will be multiple deals. So that is happening. There are deals of varying sizes going on. A few $1 million, double-digit $1 million, all those kind of things are happening. The momentum is pretty strong. In digital, our investments are also high. So you can't say it's a high margin business. We are definitely able to deliver the company margins, but because our investments are also high.
Sure. Okay. Is it, as more of your business shifts towards digital, will we see, both top line and bottom line qualitatively change? You're going to have to chase more deals to meet, the volume growth that you traditionally did in your incumbent business, because there the deal sizes were larger, right? So is there many more deals in the digital business to reach that quantum or that size of revenue? Would that be one way to look at it?
No, not really. I think the way to look at it is that as long as you keep the whole business towards key clients, nothing changes. What do we do at the end of the day? Whether you call it a digital deal or an infrastructure deal or whatever you want to call it, we have got key clients and we're trying to grow with those key clients. For TCS, I'm putting it in a very simplistic fashion. You go across verticals, across markets. Fundamentally, we are going with key clients. And the key client matrix is nicely growing. And I would like to keep it that way.
But how does the digital business measure up against TCS's traditional business when it comes to deal sizes, profitability and revenue per employee? While TCS CFO Rajesh Gopinath does a comparison for us.
In our business, all new technology service lines come in at a higher realization point, but typically at a lower profitability.
Because of the investment?
Because of the investment, because of the lack of scale, because of lack of maturity of the business models, and us not understanding how to tweak the effectiveness levers properly. And as they ramp up, then their profitability actually improves over time. Finally, when they become on the down curve, again the profitability starts to deteriorate because you start facing competition from a much different kind of a competition set, and you're not relatively listening. So that's the normal curve. Digital is currently in its ramp-up phase. So the profitability really will kick in probably as we get closer to those kind of numbers, maybe a couple of years down the line, when we start seeing multi-billion-dollar run rate and being a larger percentage of our business, which we have had time to optimize on.
If you were to contrast what digital deals look like versus your traditional deals, both in terms of the size of the deals, the profitability attached to the deals, the kind of people involvement in the deals. So let's say deal to people ratio, if I could. Can you draw out a comparison chart for me based on where you all are today?
So, my answer keeps on going back to the same thing, that you got to keep it in the context of where it is in the technology life cycle.
I guess,
any given technology.
As we sit today, what does it look like?
Typically project sizes are smaller.
How much smaller? That's what I want to know.
We are talking of currently multi-million project sizes rather than tens of millions of project sizes. Okay. And these are projects rather than large-scale outsourcing kind of relationships. These are not large program conversion kind of ones. So those kind of projects typically are high touch. They're from a margin profile, as I said, the margin profile partially because of the project nature and partially because of our own efficiency factors will typically come in at a lower number. But that is always true for any new technology take-up.
Okay.
So as the technology starts permeating, the project sizes will also start increasing.
Okay.
So the best way that we can characterize it is digital is today where web technologies was in 2005, 2006.
Okay.
And if you go back to 2005, 2006, web was as dramatic a change as digital is today.
Promising to be. So
it's in the nature of the technology business.
And people to deal ratios or anything like that? Any more insight that you can give us?
No, as I said, it's high touch. So your the revenue productivity will be lower because the deal size itself is lower. So you need so much more of selling activity behind it. Other than that, nothing much to think. But once you get in, the recurring revenue stream should fairly rapidly. See, if it doesn't expand, then anyway it is not a big thing. If it becomes as dramatic and expands, then its profile will change towards a more normal profile.
So we're at takeoff stage for profitability in digital?
Slightly behind that, I would say.
And at takeoff stage for an improvement in revenue per employee for digital. Is that a fair way to put it?
The second one, definitely. Okay. Revenue per employee on the digital side should be...
Profitability
will probably... maybe slightly longer than that.
Well, those are the key takeaways with regards to TCS's digital business, which of course as of now is still a fraction of its overall business, but the management seems confident that the overall business is also set to do well in the second quarter. It's anybody's guess though whether TCS will be able to make up for lost revenue in Q2 and maintain last year's revenue growth of 15% or not. With that, it's back to you guys in the studio.